Welcome to Catalyst. I'm Madison Mills. 30 minutes into the U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, we're going to break down the biggest market action impacting your portfolio. We're going to have full coverage of that ahead. Plus, we bring you the latest insights on the tech trade. Can Wall Street's favorite sector continue to outperform? And we'll sit down with the CEO of Gap to break down the retailer's earnings. Full coverage ahead. Taking a look at the major averages 30 minutes into the start of trading. Let's get you a check on the market. Still under pressure this morning. You've got your S&P 500 off about 0.5%. Your tech-heavy NASDAQ off just about 0.8%. And we're getting in the Michigan sentiment data coming in here unchanged at 52.2 after a preliminary reading of 50.8. So the index coming in bang in line with the prior month's reading at 52.2. The current economic conditions index did fall to 58.9. Last month, it was 59.8. So that is a fall to the downside. The expected change in median prices in the next 5 to 10 years also fell to 4.2 compared to 4.6% as the preliminary number. And the expected change in median prices during the next year, that rose to 6.6. But again, that is a downward number compared to the 7.3% preliminary number there. And again, that headline number unchanged coming in here at 52.2. We've really been monitoring consumer sentiment as an indicator of how consumers are feeling about tariff policy, tariffs continuing to be mentioned in this consumer sentiment report from the University of Michigan as something that they are concerned about when it comes to personal finance going forward here. You can see here putting some stocks under pressure. But let's look at how the bond market is responding. The bond market has been responding to the economic data, especially at the front end of the curve, and that's exactly what we are seeing this morning here. You've got your 10-year just about flat, moving up just a touch here on yield, and you've got your 30-year yield up about a basis point as well. Well, Gap sinking on the expected cost of tariffs despite reporting better than expected first quarter results. Let's toss it over to Yahoo Finance executive editor Brian Sozzi for his conversation with Gap CEO Richard Dickson.
All right, thanks so much, Maddie. Richard, always great to see you. Maddie mentioned the stock decline down about over 20% in the results. To the average investor out there on our platform right now, does this stock decline reflect the trends you're seeing in the business?
Brian, first off, we don't manage our day-to-day business focused on the daily stock price movement, and clearly it's a dynamic market out there. But what's most important is that our brand reinvigoration is really working, and it's showing in our results. I mean, this was a strong quarter. We exceeded expectations across all key financial metrics. The strategic priorities that we've laid out are very clear, and despite a dynamic environment, we're staying firmly on course. It's showing up in the results. Comps up 2%. This is the 5th consecutive quarter of positive comps for us. Importantly, we gained market share for the 9th consecutive quarter. We expanded gross margin and operating margin during the quarter. We controlled expenses. And most importantly, we increased our EPS by 24%. And lastly, we continue to strengthen our balance sheet. We've got a strong cash balance of $2.2 billion. Honestly, the Q1 performance is yet another proof point that the strategy is working. I remain incredibly optimistic, realistic about the opportunities ahead. And as we navigate a highly dynamic environment, we're really quite pleased with the progress.
Richard, I've talked to you every quarter, I think, since you took over as CEO. And every quarter, I would say Gap has been like a runner, like getting increasingly faster. The turnaround is gaining steam. And then it's smack. Now we're in a trade war. Has this trade war stalled the progress you've been able to make within your brands?
No. I mean, look, there's like any business, and we've talked about this before, we're constantly navigating complexity. And there's all sorts of complexities in running a business. And in this case, tariffs is a focus. But it's our responsibility to do so without ever compromising the long-term integrity of our strategy. And as we know, the most important part of this is the consumer. So we're very concentrated on ensuring that the consumer proposition and the value orientation of our brand resonates, and it is resonating. Again, 9 consistent quarters of market share gains. We're breaking through in a competitive landscape. We're reinvigorating our brands, and the statistics are showing that our progress is really there.
Richard, I was talking to this week the CEO of HP. Of course, they make printers and PCs. And he gave me an interesting stat. He said, Brian, we're going to be out of China very soon, completely out. It shocked the hell out of me. I mean, are you there yet?
Well, China, as an example, in our last conversation, I think I shared with you that China was about less than 10% of our sourcing, which we've been diversifying our sourcing footprint for several years. I'm really pleased with the team's progress, quite frankly, in continuing that diversification. We shared yesterday that we now expect China to be less than 3% by the end of this year. So a real diversification in place. And by the end of 2026, we're planning for no country to account for more than 25%. Also, one of the important notes is we're investing in the U.S. as we plan to double our vendor sourcing of American-grown cotton in 2026 as part of our diversification strategy.
Are you able to, let's call them capsule collections, will there ever be a time when Gap is making clothes in the U.S.?
We do have some manufacturing in the U.S. We do denim, we do some T-shirts, we do knits. We do also run all of our design, development, all of our retail operations. We're an iconic portfolio of American brands. We have about 90% of our sales in the quarter in the U.S. We have an American workforce of over 65,000 in the U.S. It's an incredibly important market for us. We've got great vendor sourcing partners domestically, and we already use a significant amount of U.S. cotton. And as I said, we plan to double our sourcing of U.S. cotton in 2026. We're increasing our design investment. We're working with very exciting design houses in the U.S. So we continue to constantly evaluate opportunities and also concentrate on where we can invest domestically.
Just given the globalization push for retail the past 10, 20 years, Richard, has that ship just sailed in terms of making clothing at scale in this country?
Look, I think it's a big question with answers that are well known in our category. To the extent that we have a very diversified sourcing footprint, it is important. We are the #1 e-commerce apparel business in the U.S. We are the #1 specialty apparel chain in the U.S. We've got a very large business across all categories of apparel. So it is important that we have agility in our manufacturing and sourcing footprint, and we're really pleased with the progress that we've made, and it does create a resiliency to the company that we're enjoying right now.
If there are no trade deals, if there isn't a trade deal with China this year, Richard, does that bring the lower end of your guidance into play for the year?
Look, I think our outlook, first off, as we shared yesterday, first and foremost is transparent. We were very purposeful in separating the outlook from the estimated tariff impact. And we believe that the outlook that we provided gives a real perspective of the underlying health of the business, which is working, as evidenced by the exceeding expectations in the quarter, and both Gap and Old Navy being obviously a strong performer in the quarter, as well as consistent. So the estimate impact of the tariffs could still change. A couple days ago, we had new news in relation to the tariff. So the first half of 2025 should be largely unimpacted by current tariffs. There's nothing in Q1, minimal impact to our Q2 outlook, and the estimated tariff impact that we provided today and that we've shared with our investors is it's primarily weighted to the second half. And as we also know, there's going to be more information to come. It's a constantly moving target. There's another milestone day in terms of information on July 9th. So what we wanted to make sure is that we stay true to the long-term integrity of our strategy, that we monitor our business associated with tariffs. We're very realistic about it. As we've shared, we've mitigated over half of the challenge on tariffs. We're determined to drive, again, the other half as well, and continue to do what we do with, executional excellence.
Richard, I think I've told you this before, but I think the turnaround at Old Navy is not being talked about enough. Now you have Lindsay Lohan out there doing commercials. Good to see her back in the fold. I dig me some Lindsay Lohan. But you also talked about in the earnings call about a lot of new, income demographics that are coming into the Old Navy chain. Bigger picture, right now, given where the consumer is financially, tariffs, you name it, is this just a perfect environment for a chain like Old Navy?
First off, thank you for talking about Old Navy. We love our performance. We love our Old Navy brand. We delivered a really strong comp performance of 3%. It is the 9th consecutive quarter of market share gains. As you know, we've been concentrating on strategically intending to drive categories like active and denim. You mentioned Lindsay Lohan. We've got Dylan Efron in that spot, Quinlan Blackwell. We've even got Charo in there. It's our latest campaign, really focusing on active. Old Navy is the #5 player in the category, and we continue to gain share in the quarter. We've launched our Studio Smooth collection, which outperformed our expectations, and it's another step forward in the largest category in the industry. Denim was another standout category. Share gains throughout the portfolio, but particularly on Old Navy. It secured Old Navy's position as the 4th largest adult denim brand in the US. We also launched occasion dresses, which did incredibly well with strong full price sell-through. So there's real intent from a design, development, and marketing on certain categories that we believe we have a right to win in. And it's a good example of not only pricing power, but when you really take big ideas with great product and great marketing, consumers find you. And these are foundational elements that we've established with Old Navy that underpin the brand's Q1 performance and is giving us great confidence, obviously, as we move further and further into 2025.
Pretty soon, Richard, it'll be mid to end of July, back to school shopping. I've started to see a lot of new, well, I guess 90s trends have come back into the fold. Giant wide leg jeans. I remember these when I was in high school. You're a pretty cool guy. Well, what's going to be the hot back to school styles?
Well, I think you're calling it out. You know, we've seen baggy continue. We've also seen embroidered denim, horseshoe, all the fits that we've introduced in denim are resonating really well. I mean, the category is being driven by the assortment. And we've taken a very strong position in identifying being the trend destination for denim across all the different fits. We've also saw soft essentials really start to take hold. Fleece has just been incredible. And you're right, the 90s trend, this sort of look back and retro perspective, it really does play very well into our portfolio. But it's most important how we execute against that trend. And I think what you're seeing is, as part of our reinvigoration playbook, it does identify, if you will, great creative, great trend-right products that are amplified by terrific storytelling. And that's translating to greater cultural relevance, which is driving revenue. And each one of our brands is at a different point in the process. But I have to say, Brian, I'm incredibly encouraged by the team's commitment in their execution and the improvements that we're continuing to make across the portfolio.
You know who's ripe for the next Gap ad, Richard? The American Pie crew. All about the 90s stuff right there. Wide leg jeans, you name it.
You got it. It could be next up. You never know. We do have a lot of exciting collaborations coming, and I know, Brian, you're going to be interested in a few of them.
All right, Richard Dickson, Gap CEO, always good to see you. See you at Cannes. Maddie, back to you.
Sozzi, thank you so much for bringing us that conversation. Really appreciate it. Well, Gap is just the latest retailer sounding the alarm on the effects of increased tariffs. Now, trade uncertainty is at a high, with an appeals court pausing the block on President Trump's global tariffs. President Trump lashing out against China, saying they violated their trade agreement. For more on this, I want to bring in my co-host for the hour. We've got Lous Basenese, the Executive Vice President of Market Strategy at Prairie Operating Co, and also the founder of The Big Skinny. Lou, great to have you back with us.
Great to be here on a Friday.
Appreciate it. Talk to me about how you are thinking about this tariff policy and how it interacts with your investments.
It's the Karate Kid market, like tariff on, tariff off. I think you have to see the forest through the tree of this and see what has happened historically, right? There's been market overreactions every time. Certain sectors selling off much more than others. And then we get a change in the tariff wind, and now everything's rallying back. And I think, the Gap interview was very instructive because it proves a data point. There's NBR research that said most companies absorb about 50% of tariffs. And if you heard in that, he said, we've mitigated about 50% of that. So I think a lot of people don't understand that most companies will try and absorb the shock of the tariff and keep it from the consumer as much as they can. And you're seeing that in the results if we look at earnings. So as much as there's been volatility in the headlines and some of the prices, it hasn't happened in the businesses yet. So for me, that's the tell. What's the underlying fundamentals of the business? Have they been impacted by prices? I give credit to companies like Gap, a few others that have been giving guidance that is transparent. Here's our guidance with tariffs, here's our guidance without tariffs, because that gives you as an investor and as an everyday investor clarity of, is it really at a risk that I have to worry about with this company? In margins, low margin businesses, obviously it's much more of a concern. high margin businesses, I think it's less so. I mean, look at NVIDIA this week, right? Huge hit because of the ban on China. And they're like, yeah, it was a bump in the road. We think we can overcome it because the demand is so strong. So I think you got to stay the course and look for pockets of opportunity to buy on the volatility is the short answer to that really long one that I just gave you.
No, that's perfect. And when you're looking for those opportunities, like what's the right investing framework? This week, the taco trade gained a lot of popularity, standing for Trump always chickens out, according to an FT columnist here. Is that the framework to apply when you are picking stocks to pick up?
Yeah, so I look at it a little bit differently. I don't want to get caught in the meme of the day. I want to look at where is their value and where is their growth, and I'm willing to pay up for some growth. So for instance, when semiconductors sell off very sharply, I'm always a buyer there, whether it's NVIDIA or the index itself, because you look on the underlying growth trend, we're not getting away from chips anywhere. I mean, we look on this table, these cameras everywhere, they're in everything now. Wearables, the long-term growth trend is up and to the right, undeniably. So I think there. But then I think you look for pockets of value. Right now, the energy sector is the most undervalued sector in the S&P 500 at about 14 times earnings versus the next closest at 16 and a half. So I think you want to be opportunistic in those places where you know that you're getting a good price and a good value at the same time. It may take a little bit longer to work out, but when buying low, you build in a margin of safety that you don't get when you're trying to chase NVIDIA at 20 plus times earnings or the Mag 7 at 25 plus times earnings.
Right. So when you're thinking about growth versus value, your answer would be both. Find opportunities in both.
Look, I came up classically trained at Morgan Stanley in a private client group, every asset class, every style and value. And you figure out the places where you can have an edge. And I think that's in small caps, in these dislocations in the market like we're seeing with data, right? Soft data has been really bad, but the hard data has been pretty good. I mean, we're just now seeing a turnaround in consumer sentiment, but consumer spending has been solid. So I think you got to look for those pockets and you're allocated and diversified, but be tactical on volatility to find new opportunities.
Lou, always appreciate it. Thank you. You're going to stick with us for the hour for more of that insight. We're going to have all your markets action ahead here on Yahoo Finance, so stick around. You're watching Catalysts. Now time for some of today's trending tickers. This morning we're watching Marvell, Netflix, and Zscaler. First up, Marvell's earnings were not strong enough to impress the street. The chipmaker delivering earnings and guidance in line with expectations. Marvell reporting 76% revenue growth in its data center segment, really mirroring this idea that we have heard throughout this earnings cycle of data center revenue being a lift to these companies. Lou, I want to bring you in on Marvell. We were just talking about how you approach some of the chip sector names. Would you be a buyer of Marvell on this dip?
Marvell is really interesting because they do have good exposure to the AI growth trend in the data center, right? They also have a segment that's growing fast in interconnects. We think about the AI as just compute power, but it's also moving that data around. So Marvell's got exposure there. The drag is the automotive sector. They have about 16% exposure there, and it was down 12% in the quarter. That's where I look at chips now is like, there's a company that I love that's undervalued, NXPI, but they have really big exposure to automotive as well. So you have to, if you're a buyer here, it's got to be on valuation and hope that the automotive sector picks back up in the end of the year. So I think the fundamentals are there if we can get through the trade wars, maybe, but that's on Friday. We don't know what happens by Wednesday.
Exactly. No, very, very well said, as always. Let's also talk about Netflix getting a pair of price target bumps from BofA and Evercore ISI. Evercore citing the company's live events as a key growth catalyst. The stock rocketing higher this year, up over 30%, trading near all-time highs, still above 1,100, approaching $1,200 a share for Netflix, which is just crazy. And Lou, I just wonder how you're thinking about Netflix. I get mixed opinions when I talk to people about
I've never
this
chased
stock.
Netflix. For me, the great unbundling to these streaming services has now gotten more expensive because the average person household has 4 subscriptions and they're paying more than traditional cable used to be. And Netflix has been a huge consumer of capital too to produce content. So for me, it's a hamster wheel to nowhere. It's subscriber growth. It's just, for me, there's better opportunities in the market. That being said, Netflix is the undeniable leader here. I think the move into live events is very smart. It's a way to differentiate outside of, because everyone's generated really good, compelling content on their own platforms, whether it's Hulu, Netflix, HBO, it doesn't matter. Everyone's gotten really good at that. So this is something that is giving them the next leg of growth. But I have a hard time trying to chase it up here at $1,200 a share almost.
Yeah.
Maybe
it's
a split
expensive.
is in order. Maybe I'd think differently.
Maybe a split.
Follow in suit of NVIDIA and make it more affordable.
All right, we will pull that quote back when we get that stock split at some point. Finally here, let's talk about Zscaler defying the slump in the cybersecurity earnings this quarter, topping analyst expectations and its own guidance in its Q3 results. Jefferies analyst raising his price target on the back of the report, saying Zscaler is, quote, the first cyber company to execute well through April as macro uncertainty has weighed on competitors in the space, and you see the stock up over 8%.
Yeah, I think as investors, longer term, if you're not focused on this week or this quarter, there's two trends you have to be exposed to. It's cybersecurity, because we've criminally underinvested in it, and we're always reacting. We can never get ahead of the threats. So I think it's encouraging to see here. If you look at hiring trends, spend on cybersecurity, they're all going in the right direction for this to be what I'd call a forever growth trend, because we're never going to get in front of it. But then the other one is semiconductor. So I think these, out of the two, call it 10 big tech trends that are out there, whether it's EVs, AI, I think you really got to be wed in your portfolio to cyber in some way. There's no silver bullet solution though, so I don't advocate buying an individual name, because there's no one company that can protect against everything. So an ETF like Hack was the oldest cyber ETF, is a great way to get exposure. Same thing with semiconductors. If you don't want to deal with the little nuances of who has auto exposure or not enough AI, you play the ETFs like SMH, and you tactically allocate on dips. So I think really good opportunities coming up here. This is proving it out. Zscaler showing even in a tough market, the right solutions will work in cybersecurity.
Great overview, Lou. Thank you so much. Appreciate it. And also, you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up here on Yahoo Finance, we're going to have all of your markets actions. So stick around. You're watching Catalysts. Turning now to the outlook for the tech trade. Tech stocks getting a little pop off the back of NVIDIA's earnings earlier in the week. Today, the sector slowing a bit along with the broader market, with trade uncertainty still looming over investors. What can we expect for tech going forward? For more on this, we've got Dana Diaria, Investnet Solutions Co-Chief Investment Officer and Group President. Of course, my co-host for the hour, Lous Basenese, is still with us. Dana, it's great to speak with you this morning. Thank you for joining us. Obviously, with the trade uncertainty remaining in place here, how do you think the trade war is going to net out in terms of its impact on the tech sector specifically?
Yeah, well, I mean, we have a trade war where the Trump administration is actually directly attacking certain companies, tech companies. So, to try to forecast exactly where we land is obviously, fraught with peril. But there's a few things I would say. One, we know that we're going to have an ongoing volatility related to comments that are made purely for the purpose of negotiation, right? That they don't in any way represent what the end game of this is going to be. The latest, of course, being, kind of the lash out at China. China is violating our agreement, et cetera. What does that mean for the tech sector? Kind of, working with China, exporting there. I mean, we know NVIDIA already had a write down based on export controls, et cetera. So I think we have to separate what is, sort of jawboning that's related to this negotiation process and where we actually think that we're going to land. And, I would hesitate to kind of forecast any of the tariffs. But at the end of the day, this is a sector that has remained strong. Q1 earnings have remained strong. Yes, they're highly concentrated in the index, so market cap is very elevated. But earnings thus far are, kind of keeping pace to a certain extent, right? And so I would not count the tech sector out, even though they are sort of in the middle of this trade war tariff talk.
So how much can we count the tech sector in? If tech was one of the primary drivers of the lags that got us to where we're at today, can tech be the savior of the market still in the second half of this year?
It's interesting. So I think tech's position has sort of shifted from this kind of almost defensive play, because they throw off a lot of cash, right? These businesses are solid businesses creating their own cash. So less susceptible to interest rate concerns. Obviously, the fact that we're going to be higher for longer, they're growthy, and, typically that would hurt a growthier play, but it hasn't really impacted the tech sector as much. What we have seen more, though, is tech kind of transitioning from this defensive play kind of posture to more of the risk on trade, right? And so, and a lot of that is, we have AI is a big part of the narrative, obviously, as to how well tech does. And so I think what we continue to see, and to your question on, kind of does it save the market? I think to a certain extent, the answer to that is just correlated with where do we see the risk trade in general, right? Do we think that things are sort of calming down? We know we have unemployment is staying, low enough that the Fed is kind of empowered not to reduce rates. Inflation's kind of staying tame right now too, in spite of now we are, now a month into some of these tariffs taking effect. So, the economic picture looks pretty good. And we're seeing earnings announcements like the NVIDIA announcement that are positive. So I think to the extent that we don't have sort of a major own goal as it's related to some of the tariff, possibilities, obviously there's concern in the market around the tax bill and the implications for the deficit, but the economy looks to be still on fairly decent footing from the hard data perspective, and the tech sector sort of leads the way on that. So I'd say, you have, look, if you're an average investor, you have a ton of the tech sector in your portfolio. I wouldn't overweight it. I wouldn't add to it because you have a ton of it already. But I do think it has the solid capability to, keep driving us forward.
And Dana, my guest has Lous got a question for you.
Dana, you mentioned about whether favorably or unfavorably certain tech companies get singled out. NVIDIA has got the burden now of carrying the whole rally on its shoulders. Before that, it was Apple. Talking about a risk-on trade now coming on, is there another tech name, even maybe it's not in the Mag 7, that can really take the baton from NVIDIA and lead the next leg of the rally higher, in your opinion?
Yeah, I won't name a particular name, but I'll answer it this way. I think there's a whole constellation of companies that are sort of the next tier that are going to drive this AI trade. Not all of those are US based, by the way. I mean, certainly with sort of the volatility that we have in the US now, there's been a much of an impetus. We see it in our flows on our platform to kind of look back at international, right? And some of these international stocks that are sort of that second tier around that supports AI, that will benefit from, continued prevalence of AI. I mean, we know, for example, the energy trade has benefited a lot from this. I think some of those, other types of semiconductor type names and, just parts of the sector that aren't they're not as influential now from a names perspective, but they certainly stand to benefit from a continued push into the AI trade. I think, that's a place that obviously can benefit. But again, I don't say that in the sense of, overweight this, right? Because I think, we represent retail investors, retirement assets. It's not the place, certainly if you have some play cash and you want to kind of put it into one of these places, by all means, but in your core portfolio, you own such a slug that's really dependent on the AI trade already. Kind of going there in any greater capacity just sort of adds to your concentration risk.
Dana, really appreciate it. Thank you so much for making the time this morning. Google and the DOJ's historic monopoly case is coming to a close after months of debates. Attorneys are poised to spend all day making their closing arguments as the search giant fights to keep its Chrome business, something that could dramatically shape up the world of online search. Joining us now, we've got Adam Kovacevich. He is the founder and CEO of the Chamber of Progress. Adam, great to speak with you. What are you anticipating when it comes to the decision in this case?
Well, I'm kind of watching what I call the 3 Ds in this case. The first, as you said, is divestiture. The Justice Department has asked Google to, be required to spin off Chrome. I think that's very unlikely, but there's been some discussion of that. The second is deals, and that's really the heart of this case, which is really Google's deals with services like Apple and Samsung, search default deals. That's the heart of the case. Does the judge approve restrictions on Google's ability to pay for those default search deals going forward? And if so, what does that look like? Is it a blanket prohibition? Is it what some people call a ballot choice screen? We'll see what that looks like. And the third is data. And this is really a wild card because what the Justice Department has asked for is for the court to mandate that Google share huge amounts of its search algorithms, search data with rival search engines like Bing and DuckDuckGo, based on a theory that Google, used these search deals to gain an insurmountable data advantage. That would really be a far-reaching, I think, remedy that I worry could disincentivize Google to keep investing in the quality of its search results.
And I'm taking a look at some commentary this morning from an analyst over at TD Cowen saying that the DOJ's major remedies that you just ran through, Adam, are aimed at helping Gen AI providers take market share from Google. To what extent do you think that that is going to be a headline to come out of this that investors can't help but continue to keep top of mind, that this is going to potentially be a result that allows AI competitors to eat Google's lunch more seamlessly?
Well, I think that speaks to a huge tension in the case, which is when this case started and when it was filed several years ago in the beginning of the Trump, or the end of the Trump administration, the first Trump administration, it was a narrow case. And it was really just about Google's search distribution deals with Apple on Samsung devices, things like that. What's happened is after the Justice Department won the liability phase, they really threw what I call remedy spaghetti at the wall. And they said, look, let's go for broke here, right? Let's sort of invite all of our Google's rivals in and really ask for aggressive remedies. And that included things like AI, limitations on AI. Well, the fact is the case wasn't about AI, and Google's behavior was not judged on AI. So what I think the Justice Department is trying to do here is trying to use the liability finding to put handcuffs on Google with respect to AI. But in the AI space, arguably Google's behind, right? Arguably, they're behind OpenAI, ChatGPT. And so it kind of speaks to the way in which this case is being used by the government to move the goalposts, honestly, to whatever anybody is concerned about Google doing. And that's not really what this case should be about. That's not how the courts are supposed to judge it.
And my guest host, Lou, has a question for you too, Adam.
Hey, Adam, I love your term going for broke because I'm a shareholder of Google and I think it's undervalued, but it's also, some people could say I'm going for broke if this goes unfavorably. Mm-hmm. What scares me about what you said, the divestiture news is great, but data being the wild card, wouldn't this set a really dangerous precedent if they were forced to share their AI data? Because really, large language models are all about the data, and at that point, it opens up for other companies to get too big where they'll be forced to share their data. Is that a concern on your radar, or how would that be mitigated in a decision that forced Google to share data?
It should be. Look, if I run a bakery and I spent months perfecting my cupcake recipe, and it's a huge hit, I got people out the door, lines out the door, right? And the government comes along and says, no, you got a monopoly in the cupcake market, you got to share your recipe with all the other bakers in town. I'm going to be pretty demotivated to keep investing in a great cupcake recipe, right? And that's the concern, right? That this is not something that Google developed overnight. I mean, its ability to hold on to users in search is a function of countless, millions of hours of engineering and brain power to try to make its search results to be the most responsive to consumers. So they have to share all that. All of a sudden, what's the point, right? And that's a real problem.
Yeah. Here's another one for you. Who's next after Alphabet if the DOJ is successful, right? We've been talking about antitrust and breaking up big tech for seems like a decade. Who would be next on the radar?
Well, look, there's pending antitrust cases against all of big tech, basically, right? Where they started in the first Trump administration or the Biden administration. The next one that will probably come due for a verdict is the Federal Trade Commission's case against Meta, which just wrapped the trial phase. That's really about unwinding Meta's acquisitions of Instagram and WhatsApp, which are now both, more than a decade old, which is kind of crazy, but that's what that case is about. In the kind of the docket are the second Google case, which has to do with Google's ad tech business, where Google has also been found liable. That will move to a remedy stage trial later this year. Further off on the horizon is the FTC's case against Amazon and the DOJ's case against Apple, which has to do with the vertical integration. Those cases probably won't see a courtroom until 2026, maybe even 2027.
Adam, really appreciate you joining us this morning on this case. Thank you so much for that context. Appreciate it.
Thank you.
Coming up here, President Trump expected to hold a rally touting a deal between U.S. Steel and Nippon Steel. We're going to break down the details next on Catalyst. Stick around. President Trump set to hold a rally in Pennsylvania celebrating a deal between U.S. Steel and Nippon Steel. Remember, back in 2023, Nippon Steel proposed a $14 billion takeover of U.S. Steel, which was blocked by then President Biden. Meantime, Trump has set to tout the plans at a steel processing plant today and perhaps offer more details on the notion that the U.S. could receive a golden share. Here to break down all of this and more, Yahoo Finance Washington correspondent Ben Merschel. Ben, walk me through this deal though. Walk me through the golden share here, what that means and what this looks like in terms of likelihood for this working out, given where we know the president is heading today.
For sure, yeah. So this golden share concept is the factor here that seems to have flipped Trump on the deal. It's worth noting that this is a sort of complete 180 for Trump on this Nippon U.S. Steel deal. During the campaign, he promised to stop it instantaneously when he's office. Now he's going to rally at a U.S. steel processing plant. We don't have a ton of detail at the moment on what a golden share, what he exactly means by a golden share. The way he described it earlier this week is that the U.S. would have control over the company. Nippon Steel hasn't publicly agreed to terms like that yet. Golden shares are a relatively common thing overseas, where the government takes a role in companies, but it's unclear whether this will be a literal equity stake or it'll be sort of similar to how the U.S. controls foreign investment through programs like the CFIUS program, which reviews these types of deals and was involved in Biden blocking it. Overall, though, I think it's notable here that Trump's embrace of this and his apparent excitement for the golden share concept is part of an overall trend from Trump that stretches back to previous administrations of U.S. companies, the U.S. government getting more and more involved in U.S. companies. It had echoes to me of Trump talking about how he's going to watch Walmart and whether they're going to change tariff prices. These are micro-level company details that Trump wants to be involved in, and I'd note that there was echoes of that in the Biden administration too. The last golden share concept was actually the auto bailout under the Obama-Biden administration, where the U.S. took a stake in GM and Chrysler at the time before selling it off pretty quick. So it's a lot of details to be seen. Trump is going to rally. It's at 5 p.m. where he may give more details, but then the deal is expected to be formalized next week.
And Ben, walk me through why this makes sense for the president politically, because obviously he previously opposed the deal. What changed, and why does it move the needle for him to do this?
I think the main message you're going to hear from the president tonight, which the White House press secretary alluded to yesterday, is about jobs. It's not a coincidence that U.S. Steel is headquartered in Pittsburgh, Pennsylvania, the swingiest of swing states. He's going to go there and talk about protecting U.S. jobs. So that's the message he's hoping is taken from this. It sort of belies the fact that most of the underlying aspects of this deal are unchanged, other than this golden shares. What we're expecting and what the deal has been telegraphed is the headquarters stays the same. It stays in Pittsburgh. It stays with the U.S. CEO. But that's what Nippon Steel promised last year. So it's sort of a messaging operation, I think, is a big part of this, as opposed to really changing the deal, other than what this golden share concept could entail.
Ben, always a great overview. Thank you so much. Appreciate it. Coming up, as markets react to renewed trade tensions, we are getting a read on investor sentiment from one financial advisor. Stick around for that next. Markets are under pressure about 90 minutes into the trading day as investors react to renewed trade tensions between the U.S. and China. The S&P 500 heading lower on the last day of what could be its best May performance since 1990. So how should investors build a portfolio that can withstand the good and the bad amid the trade war? I want to bring in Andrew Fincher, financial advisor at VLP, for this week's FA Corner, sponsored by Invesco. Great to have you this morning, Andrew. I just mentioned the volatility of the market following the addition of these tariffs, but the S&P 500 is up 4% from April 2nd when the reciprocal tariffs were announced by the president. If investors have sort of broadly started to price in a post-tariff reality, how does that impact what you tell clients about whether or not to continue to position in a way that protects them from any tariff uncertainty?
Sure. Well, first and foremost, Madison, thank you for having me on. And I think when we have these conversations, the first place you have to start with is risk, right? So our job as advisors is to first meet the clients where they're at. So every client has their own appetite for risk. So our goal is to explore that with the client and understand their emotions before we can even get into guiding them on how to navigate that uncertainty. At the end of the day, it always goes back to that planning component, right? Like, we can talk about the markets and all the different pieces of it, but investing is a tool. It's a means to accomplish those goals. So understanding how a diversified approach fits into that plan allows us to sort of frame the discussion before we can get into the details of particular sectors or what that looks like overall.
And talk to me about what you're advising clients on when it comes to specific sectors. I know you mentioned in your notes over to us that the elevated PE ratio for NVIDIA is still a risk to you. How does that impact how you talk to clients about tech, for example?
Sure. So tech is a very important factor when it comes to large cap growth and just a general diversified portfolio. So, when we look at NVIDIA, for instance, when we talk about potential expansion moving forward, NVIDIA passing their earnings expectations, that shows that there could be some expansion there. But at the same side, you look at it and PEs are elevated, so that could persist some volatility. So when you're looking at it, we could talk about whether, we see a positive projection or there could be continued volatility, but having that diversified approach so that you don't have to worry about specific sectors, it allows you to be able to navigate that, right? So you talk about tariffs, that's a big conversation now. With these frameworks for the UK and China deals, and then Japan buying into US long-term debt, that could open up the door for the Fed to maybe lower rates. But at the same time, if litigation goes through on that, it could increase some of the risks for inflation, in which case maybe you would see some positives on like large cap value, where you could see, energy and financials perform well in those environments, or maybe floating rate on the bond side. So it really just depends, having that approach so that depending on whatever the market looks like, you're positioned to be able to take distributions or maybe rebalance if you need.
And my guest host, Lou, has a question for you, Andrew.
Hey, Andrew, I don't envy your position because I know sometimes you're a financial advisor and other times you're a mental health counselor. I'm curious what it's been more of in this recent bout of volatility compared to the past, per se, maybe leading up to the presidential election or through COVID. Are you counseling and trying to keep people on course more, or are you seeing more optimism and opportunistic types of conversations about, hey, I want to buy this dip?
Yeah, I think it's a lot of where people stand. So, when we look at it as a whole, some people are very concerned. And so that's where the coaching aspect comes in to understand, where's their risk at? If they don't need to take more risk, we could look at statistically and say, okay, you should be in a higher equity percentage, just for different risks. But if the client can withstand maybe a 5% return, maybe we'll lower it a little bit. But the real key approach here is understanding where the client is coming at to say, hey, maybe we have some opportunities to rebalance here, like we did in April and March, some opportunities there to buy those dips. But at the same time, we're trying to position it to really understand where they're coming from and then build off of that.
Andrew, really appreciate you joining us this morning for this week's FA Corner, sponsored by Invesco. Thank you so much.
Thank you for having me.
And a big thank you to Lous Basenese, the Executive Vice President of Market Strategy at Prairie Operating Company and founder of the Big Skinny Lou. It's always great to get your insights.
Good to be here. A good way to end the week.
Really appreciate it. Thank you so much. We, of course, will have you back soon for more on how the market is developing amid the constant volatility, especially when it comes to tariff policy. Really do appreciate it. Coming up right here on Yahoo Finance, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith, he's going to have you for the next hour, so keep it here for more.